Hi, everyone. Um, so today we're going to talk about the state of Solana DeFi. Now, it's impossible to talk about everything going on in Solana DeFi in just 20 minutes. So what we're going to do is going to talk about 6 sections that you see here, talking about the insights today and what are the trends that we should be paying attention to. So first, it wouldn't be a Blockworks talk if we didn't discuss REV. So real economic value measures user demand to transact on a blockchain, tracking all value paid for transaction execution. That includes both in-protocol fees and out-of-protocol fees, which in Solana, they are called jitter. As we can see in this chart, Solana commands around 50% of global demand to transact on chain. It has been the leading blockchain since October of last year. But why is REV important? From the point of view of the developer or the application, if I am building an application today and I have to choose where I want to build that application, I want to build in an ecosystem that is sustainable. And REV sort of signals that developers and validators in that ecosystem are getting paid to maintain the network and are being incentivized to make improvements in the network that can continuously enable the scalability of my applications. So if we look at this other chart, we measure an even more important metric, perhaps, which is application revenue. So the true indicator of a success within an ecosystem is, are businesses in this ecosystem profitable? And what we can see here is that since June 2024, Solana applications have made more revenue than all of the other blockchains. So what we can see here is that Solana apps today account for about 58% of total revenue across all chains. And the interesting thing here is when we combine these two metrics. Now, the key insight for me is that our application revenue has outpaced REV in the past few months. So if we look at this chart, we see that last year, application revenue in Solana was roughly equal to REV. So for every dollar generated in app revenue, we had roughly the same dollar generated in REV. Whereas if we look forward to today, Solana apps generate about $2 in revenue per every dollar of REV. And so the key trend here is that over time, we expect a majority of the value to flow towards the applications and not just stay in the infrastructure layer. So this provides a good bird's eye view of the economic sustainability of the Solana ecosystem, and it kind of showcases that Solana is the best place today to build an application. But what are the key trends in terms of all of the sectors in DeFi? So first, let's talk about DEXs and aggregators. So this chart shows the weekly DEX volume by per category. So what are users trading on chain on Solana? We see that 50% of Solana's DEX volume roughly is coming from meme coins today. And the second highest asset per category is the Sol USD trading per. So as we can see here, about 85% of Solana's trading volume is coming either from meme coins or from the Sol USD trading pair. Now, who dominates these volumes in terms of DEXs? Radium, over the past year, as you can see in this chart, dominated Solana DEX volumes with around a 60% market share. However, if we look over the past few months, Radium has sort of lost a bit of market share, and although it is still the leading DEX today, with about a 33% market share in terms of volume, there are two DEXs that have really been the winners in the past few months. The first is SolFi, which is a prop DEX AMM that launched about 7 months ago and today holds about 20% of Solana DEX volumes. And the second one is Pump, which launched their Pump Swap AMM and it has captured around 12% of total Solana DEX volumes today. So this is like a great statistic, but it is maybe a bit too generalized. So what are basically the insights per sector? So what we see here is basically the DEX market share by trading pair. So for instance, within the meme coin vertical, Radium makes about 56% of volumes, whereas Pump makes about 23% of volumes. So you can see that there are basically two dominant DEXs in the meme coin vertical, which is Radium and Pump Fund. Now, I want to highlight two other insights from this table. The first is SolFi, which, as I mentioned, despite launching just 7 months ago, they are the leading DEX both in Sol USD volumes and stable swap volumes, with about a 40% market share in both categories. And then the other insight is that Orca leads in project tokens, Bitcoin volumes, and LST swaps. However, these categories combined represent just about 10% of total DEX volumes. So when you look at the overall rankings, that is why Orca isn't as high as the other two. And one of the key things here is that if we look at the DEX volume composition, you notice that in the DEX space specifically, specialization is the name of the game. And what I mean by this is that if you look at the two largest DEXs by market share, which is Radium and SolFi, both have around 80% of their volume coming from a single asset type. So in Radium's case, that asset type is just meme coins. And then in SolFi's case is the Sol USD trading pair. And this is really interesting because it also showcases where volume should be coming from. So if you look at where volume originates, we see that DEXs that are more reliant on Sol USD volumes have a higher percentage of the volumes originating from DEX aggregators. So for instance, both SolFi and Lifinity, which derive the majority of their volumes from the Sol USD trading pair, have over 50% of their volume coming from DEX aggregators like Jupiter, DFlow, or whatever it may be. Whereas you observe the opposite behavior with DEXs that are more reliant on meme coins. So for instance, both Pump and Radium, which have the highest concentration of meme coin volume, have the lowest percentage of their volume coming from DEX aggregators. And what we see is that different users' behaviors in terms of trading, for instance, a majority of the volume for these DEXs may be coming from Telegram trading bots or arbitrage bots taking advantage of like sniping and opportunities with long tail assets. So looking forward, I want to highlight two key trends that we're paying attention to in the DEX space. I think the first one is the rise of meta aggregators like Titan and CaminoSwap. Aggregators like Titan not only have their own routing algorithms, but they also aggregate other aggregators like Jupiter, DFlow, and off-chain sources like Pitts Express Relay. And what that can do is that it can offer the best price execution for users over time. And we expect over time to have even tighter and tighter spreads in the Solana DEX trading scene. The other key trend that we're paying attention to is what I was referring to earlier when it comes to specialization being the name of the game. I think like if we look at assets, we can divide assets between like long tail and liquid markets. So long tail assets will be something like meme coins. I expect traditional AMMs like Pump and Radium to keep dominating this vertical. And then for liquid markets, such as the Sol USDC trading pair, you have things like SolFi and off-chain auctions like Pitts Express Relay. I would expect these DEXs to capture the majority of the volume for liquid markets over time. So these are the insights that we're looking for in the DEX aggregator space. Now, what are the things occurring in the perps landscape on Solana? So what we see here is the perps volume protocol over time on Solana. Both Jupiter and Drift account for over 90% of Solana perps DEX volumes. What is interesting here, in my opinion, is that Jupiter only offers, until today, just 3 assets, which is BTC, ETH, and SOL. And despite offering just these 3 assets for trading, they still account for roughly 74% of the DEX trading volume. But if we zoom out and look beyond the Solana perps landscape, we see that Solana hasn't been very successful in this vertical. Here we compare Hyperliquid versus Solana's perps trading volume. So Hyperliquid, which is built on its own L1, roughly makes about 6 times more trading volume than all of Solana perps protocols combined today. And we can ask ourselves, what is missing in the Solana ecosystem to bridge this gap? Why haven't perps DEXs on Solana been as successful as Hyperliquid? And in my opinion, the most important thing to pay attention to here is toxic order flow, which is the most significant barrier for market makers to provide tight spreads on Solana today and for high frequency traders. So this is a chart that was included in last blog post by Max Resnick and Tolley. And it showcases that toxic takers on Solana today have a structural advantage over market makers. And this is because Solana is a permissionless blockchain, so you cannot have like opinionated ordering of transactions. And what that has prompted is that some teams in the Solana ecosystem, such as the Ellipsis Lab teams, which, as I mentioned, has been building SolFi, is also building their own chain, which is called Atlas, which is an L2 with opinionated ordering of transactions. And you also have other teams, such as the Fogo team, which runs on a unified implementation of the FireDancer client, building their own chain to focus on these specialized financial applications that are not possible to build on the Solana L1 today. So for instance, Fogo solves this issue by having a permissioned validator set, which, as I mentioned, is not possible on Solana today. So the main question for me here is, like, looking 6 months, 1 year into the future, will these new chains be successful, or will volume stay on Solana, and can Solana fix these issues? So a key insight for me is that Solana core developers will do everything in their power to keep users and liquidity on the L1. And we have seen some improvements on the core developer side and proposals that can fix this issue. One example is application-specific sequencing. Another example is the proposal to have multiple concurrent leaders. And the Aspen Glow new consensus mechanism can also help with this issue, which is basically how do we reduce toxic order flow for market makers. Moving on to another very interesting category, we can look at money markets. So here we show the money market share over time on Solana. And we can see that Camino, since its launch in October 2023, has basically consolidated as the kingmaker of Solana money markets with more than $2 billion in TVL and about 60% market share. In my opinion, TVL, which basically measures net deposits, is not the best metric for money markets. I will much rather look at borrows, but the data is a bit hard to come by, but still this provides like a decent proxy. And in terms of like catalyst for money market growth in the Solana ecosystem, I would like to highlight the stablecoin circulating supply. Money markets are one of the primary beneficiaries of increased stablecoin circulating supply in an ecosystem. And stablecoin supply in Solana has grown over 4x since the beginning of 2024. It had a very big jump in around January when we had the Trump meme coin launch. And then surprisingly, it was very sticky and it has sort of stayed there. And as I mentioned, money markets can greatly benefit from this increased circulation of stablecoins. So what we see here is Camino's main market, Sol deposits and stablecoin borrows. Sol deposits on Camino's main market are approaching $1 billion, and then stablecoin borrows are also at an all-time high of $350 million. And what we see when we go into Camino is we see that there are a lot of stablecoin borrows against Sol deposits, which showcases that users are basically leveraged long Sol and are very bullish on the asset and are expressing that bet on chain. So when we look at the key trends in like the money market sector, I love this chart, which is basically showing the evolution of money markets over time. So we sort of have like the first iteration of money markets, which were monolithic and pool-based. So think about Aave or the first version of Camino. These protocols have like a unified liquidity market, which provides a great user experience, but they also have sort of like a one-size-fits-all approach for risk, which sacrifices capital efficiency. We then had the rise of modular and pool-based market like Morpho and Euler V2 and soon Camino V2 as well, which have a permissionless market creation layer, and then you have bold layers on top that aggregate liquidity and improve the user experience primarily on the supply side for users. This can enable better capital efficiency and can also onboard like institutional players. One example is, for instance, Coinbase integration with Morpho a few months ago for their CBTC product. And then I like to highlight like the latest integration, which is like modular also, but instead of being pool-based, which is what we have seen basically in the past 7 years, we have an order book-based approach. So Loopscale is a new protocol on Solana that instead of using the traditional pool-based approach, they are using a central order book to directly match borrowers and lenders. And what that can do is it can provide even better capital efficiency and create new types of markets that were not previously possible. For instance, Tarun was previously speaking about fixed rates and fixed durations. This is something that Loopscale can easily do with more specialized lenders, and it can create better structured products in DeFi. For instance, with looping strategies that have fixed rates, you no longer have the risk of rate moving against you and being liquidated. So this is a key trend that we're looking at in the money market sector, and one that we expect to continue to expand over the next few months. Since I mentioned money markets, it's important to briefly talk about yield protocols. On the EVM side, Pendle has been extremely successful with more than $4 billion in TVL. And I expect that as more yield-bearing products come onto the Solana ecosystem, we can have more growth in the yield marketplace sector. Over the past few months, we have seen the rise of both Radix and Exponent. They basically had less than $5 million in TVL in October last year, and now they have around $170 million of TVL combined, which just showcases the scale of the opportunity, but they're still pretty small compared to what we have on the EVM side. And the nice thing here is that you can have a lot of synergies with money markets that create virtuous cycles of growth. For instance, Pendle and Aave having a great duo on the EVM side, whereas when you have PT tokens on the Pendle, you can then list that on Aave and create like looping strategies that bootstrap growth for both protocols. You can have the same thing on Solana as we have more yield-bearing tokens like JLP or USD by Perena, and then list that on money markets. For instance, Loopscale lists a lot of PT tokens from Exponent and has seen a lot of growth coming from this vertical. The last thing that I'm going to talk about is a thesis of Blockworks, which is multi-product DeFi beating single product DeFi. So select DeFi apps will greatly expand their product offering, and we have seen that on Solana. And we think that over time, these types of products can beat single product DeFi. So for instance, this is an example of Drift. Drift has a cross-collateral engine that facilitates them cross-selling their users on various different products. So for instance, they have their perps and spot trading, which has like liquidity aggregation via their newly created Swift protocol. And then you also have like a prediction market with BET. When you deposit into the perps product, you can actually earn yield on the money market side, and that can automatically earn yield for users. And then you also have bolts that are managed by risk curators that can facilitate like normal users basically getting the yields of sophisticated market strategies. So we expect these types of products to outperform over time. And we have seen other leading protocols in the Solana ecosystem like Jupiter, Camino, or Radium actually do this as well. For instance, Camino is a money market, but they have also expanded into the DEX aggregator space with their meta aggregator product. And then finally, I like to conclude this by mentioning the 4 key points that I think you should take from this presentation. The first is that emerging solutions in the DEX landscape, such as meta aggregators like Titan and props DEXs like SolFi, will improve the price execution of Solana users and reduce spreads over time. The second key insight is that I think that core developers on Solana are working tirelessly to make sure that users and liquidity stay on the L1. And one key aspect of this is just reducing toxic order flow. And one of the solutions can be using multiple concurrent leaders, application-specific sequencing, and the new consensus mechanism, which is called Aspen Flow. On the money market side, I think that modularity in design with Loopscale and Camino V2 can unlock new types of markets and products, and also unlock the next phase of growth with institutional usage. For instance, we saw that Camino recently listed ACRED on their platform. And then finally, I think that multi-product DeFi, so things like Drift, Jupiter, and Camino, will outperform single product DeFi. Of course, there are some caveats here. For instance, we mentioned that in the DEX space specifically, specialization can be beneficial, such as Radium and SolFi specifically focusing on one type of assets. But in general, I think that super apps, if you want to call it that way, can outperform like single product DeFi over the long term. Thank you.